Now, it would be too good to be true if there weren't some further rules. And let's go over some of these further rules regarding these self-directed retirement accounts. First set of rules, and these are the big, mean, nasty rules. These are the rules you do not want to run afoul of. And this is something called the prohibited transaction rules. And it's at its most simplistic. These prohibited transaction rules say this: your IRA is not allowed to engage in any transaction with anybody who is considered related to the IRA owner. Once again, your IRA is not allowed to engage in any transaction with anyone who is considered related to the IRA owner. If the IRA does engage in a transaction with one of those related parties, it's basically the death sentence for the IRA. Your IRA is going to be considered completely and fully distributed at that point in time. So once again, your IRA is not allowed to engage in any transaction with anybody who is considered related to the IRA, otherwise is considered completely and fully distributed. So this brings up the obvious question: who's going to be considered related to the IRA owner? Well, number one, the IRA owner is obviously related to themselves. Next, the parents of the IRA owner are going to be considered related to the IRA owner. The children of the IRA owner are going to be considered related to the IRA owner. And finally, the spouses of the IRA owner. Just kidding, guys. The spouses of the parents, the kids, and the IRA owner are all going to be considered related parties. So your IRA cannot engage in a transaction with any of these people. Can't engage in a transaction with the IRA owner, their parents, their kids, or the spouses of any of those parties. Now also, here's a sneaky part. Inside the tax code, it says a business entity, a trust, a corporation, a partnership will be considered related to the IRA owner if 50% or more of that business entity is owned by some of these related parties. Now, I know what a lot of you are thinking. You're thinking, well, gosh, that's no big deal, because now I'll just set up an entity, I'll own 49% of it, and now I can have my IRA loan the money over to the 49% owned entity. Guys, it doesn't work that way. Under the tax code, you got the actual tax code, you have the regulations of the tax code, but then you have all sorts of administrative guidance and rulings issued by the IRS, not to mention the court cases. And there's one court case out there that says, we don't care what percent ownership a related party has in a business entity. If your IRA moves money over to that business entity, and that business entity receives some benefit from the use of that money, that's going to be a prohibited transaction as well, and your IRA is going to be considered completely and fully taxable. So this falls under the category of kids, don't try this at home. Don't try to do a self-directed IRA without further help and professional guidance. The reason being is there's just so many little mines out there where if you step on one of these little mines in the minefield, it could have disastrous tax consequences. So having said that, if a business entity has any ownership by a related party, that business entity will be considered related as well. So related parties for this prohibited transaction rules: the IRA owner, parents of the IRA owner, kids of the IRA owner, spouses of the above parties, as well as any business entity of which any of these related parties has any ownership. So quick examples here. Number one, if my IRA loans me money, my IRA is considered completely and fully distributed, and I have a tax disaster on my hands. Alternatively, let's say I'm a really crafty, shrewd guy, and I create a corporation that I only own 49% of. So if I look at the tax code itself, it looks like I'm in full compliance. Now I have my IRA make a loan over to that corporation. Bad news, guys. That is probably going to be considered a prohibited transaction, which means the IRA is going to be completely and fully distributed. Bottom line, there's 300 million people in America right now. Don't do any transactions with anybody who's a family member related by blood or anything of that nature. That should still leave, 299,990,000 people who you can still engage in transactions with. Make sure you fully understand prohibited transaction rules before you do any transaction with your IRA, because otherwise it can just be a complete tax disaster. Now there's another set of rules you need to know in regards to your IRA investments. And this is something called the unrelated business income rules. And in a nutshell, these rules basically say, under certain conditions, your IRA is going to have to pay taxes on the profits generated within the IRA. Now, what are these situations where you might have to pay taxes on the profits generated within your IRA? Number one, if you have an active business owned directly by your IRA, the tax code says you have to pay taxes on the profits. That's the key word here, the profits generated by that business. Now, I emphasize the word profits because the tax code says you're still allowed, or I should say your IRA is still allowed to use all those necessary and ordinary deductions to offset your profits inside the IRA. And that's just a long-winded way of saying the IRA only has to pay taxes on the profits generated by the active business within the IRA. What would be the definition of an active business? Well, it's better to say what is not considered active business. Any income generated from capital gains, from annuities, from royalties, from rents, from interests, and from dividends is not considered active business income. Active business income would be something like you own a tire store inside your IRA and the tire store generated a profit. You would have to pay taxes on the profits generated within the IRA. Now, other area where your IRA would have to pay taxes on the profits it generates. If your IRA goes out and borrows money and it generates a profit from that borrowed money, it's going to have to pay taxes on the profits generated by the borrowed money. Quick and dirty example, and we'll be getting into more detail on this in just a little bit. Let's say that my IRA goes out and trades on margin, and it has a $100,000 portfolio, and $50,000 of that portfolio is borrowed, is margined. That means 50% of the profits I generate inside that portfolio will be subject to taxes also. So those are the two situations where your IRA is going to have to pay taxes on the profits it generates. If it owns an active business directly, and also if it generates a profit by using borrowed money. Now let's give some examples to those rules. And I'm still caught on the whole thing that I was taken for $200 an hour to rent the jet skis. So let's use a similar example. Let's say that my IRA goes out and it buys a boat for $30,000. Now let's say that I go to a marina owner and I tell the marina owner I'm willing to split the profits 50-50 of what they can make by renting out this boat. And let's say that throughout the year, my IRA was able to rent out that boat and generated $5,000 of profit that comes back to my IRA. Renting out a boat would be considered an active business in the tax code, so that would generate that active business income, which presumably my IRA would have to pay taxes on. But guys, remember I said, under the tax code, my IRA is still allowed all those necessary and ordinary deductions. One of the biggest of which is what? Depreciation deduction. So now if my IRA bought the boat for $30,000, and if it had a 5-year life expectancy under the tax code, that means I'm allowed to write off $6,000 of the value of that boat each and every year. If I only made $5,000 from the boat rental, and yet I have $6,000 of depreciation deductions, guess what? I ran a loss for tax reporting purposes, and now even though my IRA ran an active business, it didn't have a profit, so therefore it didn't have to pay any taxes for renting out the boat. Now let's go through another example using the debt financed